Hello and welcome. I previously recorded a video showing a strategy that uses MACD tested across 6 different forex pairs. If you haven't already seen the video, I'll leave a link to that so that you can watch that and you know what to avoid, because if you use that strategy, you're just going to lose money. However, I persisted in trying to develop a strategy that is profitable, that uses the MACD or MACD indicator. And I'm pleased to tell you today I'm going to show you one that does work. As with all my videos, I'm not just going to give you the rules. I'm actually going to show you the 6 steps that I went through to develop this strategy from a simple idea to a real working strategy. So let's get straight into it and look at the computer where I'm going to walk you through every step of the process of the development. In this development, I've used data from 2008 through to 2018 for the in-sample development, and then for out-of-sample data I've used from 2019 through till sort of current day, which is December 2020, so almost 2 years worth of data. Forex data is from Oanda. So I'm firstly going to show you the basic rules for the strategy. Now, on the chart here we can see I've put on the MACD, which is made up of sort of 3 components. We've got the histogram, which is the red, and then we've got the yellow MACD line, and then we've got this cyan line, which is it's like a moving average of the yellow MACD line. Now, all we're using in this strategy is the MACD line, and we're looking for it to break above and below certain levels. Now, when I started this strategy, I literally just zoomed out the chart, I'll show you, and I was looking for extreme upper and lower levels. So I put this horizontal line, and if we see over on the right hand side, we can see it's about 0.1. The level is here is about 0.1, and on the negative side it's about minus 0.1. So they're the levels that we're going to start with, and what we're going to say is if that line breaks above the 0.1, then I'm assuming that there's a strong trend underway and we want to jump on. So we buy. So that's the buy signal. And the opposite, if it breaks below the minus 0.1, we assume that the bears are in control and we want to sell short or exit our long position. So it's a stop and reverse type always, well, most of the time it's in the market. So when we go short, we exit short and then immediately go long, and we exit long and immediately go short, unless we get stopped out. So let's quickly have a look at the results from just these basic settings. Straight away, this is the equity curve, and it's certainly moving in the right direction. Now, that's always quite promising. If something looks like that immediately, I think that it's worth going further and worth developing, see if we can get better results still. Because although the equity curve's okay, it's going up, if we look at the total trade analysis, we can see the value of the average trade is only 4,200 yen, so it's only 4.2 pips, which is a little bit low. By the time we've paid some trading costs, that's a little bit low, so we're going to look to try and improve that value. So moving on to the next workspace, this is exactly the same as what we saw previously. But what I've included in the code is a time window to trade within. Instead of taking these signals when they occur, whether 24 hours a day, I'm actually saying perhaps there's an optimal time window where we only take these signals, let's say from midday till 4 o'clock in the afternoon. We've got a 4-hour time window where only if those signals occur do we take the trade, because that's more significant. Other than that, but it could just be random market noise, and we don't want to trade false breakouts up or down. So the first thing I'll do, I'm going to check the end time. So I run an optimization, and I'll show you the results of that. So at the moment, I'm saying we want to be trading 24 hours a day. So we want to start at midnight and end at midnight. So I've done an optimization to see where's the best end time. We can see in this right hand column we've got end time. So 100 is 1 AM. So we're trading for just 1 hour between midnight or 0 and 1 AM. That's 1 hour. And we can see how this is reflected in the total number of trades. it's the least amount of trades, 338. Next one, we're trading for 2 hours, and so on. So what I'm looking for is a pretty decent, consistent, both net profit and average trade. So what I decided to go with is 1600, just because it's kind of in the middle of, we got an average trade 5,000, 4,000, 5, 5, 5, 4, 4. It's just somewhere in the middle. So that's why I've chosen 1600. And let's have a look at the results. So the equity curve, or total trade analysis first. We've got an average trade now of 5,500 yen, not 4,200. And hopefully it hasn't ruined our equity curve. Equity curve's not much better, but it's not much worse either, which is a good thing. Guys, I hope you find this sort of video interesting. If you do, then please give the video a like now and subscribe to the channel. So let's move on. So the next thing, obviously, is to look at the starting time. At the moment, we're trading from midnight through to 1600. Now these are Eastern Standard Times, or exchange times for the Forex broker. So the next optimization I ran was the start time from 0 through to 2300 again, and I ended up choosing 600 or 700. 700 has got slightly better a net profit and an average trade of 8,600. So we select 700 and have a look what the performance report looks like now. Still a reasonable equity curve. Now, the only thing I don't like is these early years. Look, up until about maybe start of 2013, the results weren't particularly great. If this chart had been around the other way, if the results had been very good for the first few years and then started to get a little bit worse, I'd be more worried. However, now, because results from 2013 have actually got stronger, maybe that reflects more recent market conditions. So we're going to go with that for now. So we've got our time window of 7 a.m. through to 1600 hours. And the next thing we want to look at is adding a stop loss. I typically find fixed pip stop losses work just as good as anything else. So we'll have a quick look and run an optimization for the stop loss. So you can see on this right-hand column, these are our stop losses. Now, 0 is no stop loss. 0.1 is equivalent to 10 pips. 0.2 is equivalent to 20 pips, and so on. Now, looking down the average trade, using no stop loss, we've got 6,200,000 and 8,600 yen for the average trade. I ended up choosing a value down here. It's actually the best value on the net profit, and it's somewhere in the middle here. So average trade slightly better, 8,700 yen. So we're going to use 1.8 as the stop loss. I don't expect much to have changed with the equity curve or the average trade, but we'll have a look, and no, it's a very similar equity curve. So the last thing I want to look at, or the two last things I want to look at, is those levels for the MACD line. I've mentioned that at the moment they're set to 0.1 and minus 0.1 for short trades, but perhaps they're completely wrong. So let's have a look. So in this next development, I'm checking the lower level. Higher or lower, it doesn't matter which one you check first. In this case, I've checked the lower level, and I've gone from 0 through to minus 0.3. Now remember, at the moment we're on minus 0.1. Looking at the average trade, for anything from 0.13 onwards is fairly negative, and we can quite quickly see that somewhere around here has the best average trade and the best net profit at 6 million, 7 million, 7.9, and I've chosen minus 0.8 just because we got a few more trades than going a little bit further, but it's clear anything from 0.08 through to 0.1, minus 0.1 works. So looking at the equity curve now with minus 0.08, slightly better in those early years, probably just better all round really. Let's have a look at the average trade value. Now we've got an average trade of 9,200 yen, which is better. So, last thing to do, you've guessed it, we're looking at the upper level of that MACD. Here we go, look, MACD upper level from 0 through to 0.3 again, and again look at the average trade and the net profit values. Some of the best ones, best net profit is around 0.05, but we've dropped on the average trade. The average trade, which is really what we're concentrating on, is the best one is 0.1 actually, which is what we originally had. So we're going to leave that at 0.1. And we've already seen the equity curve because there is no change from last time. There's one last thing that I like to do. I mentioned that I've used in-sample data. Now, this is data that I've tested on between 2008 and the end of 2018. Now, I'm going to use our out-of-sample data, and I'm going to use the most recent data set. There's different ways of doing this, but this is majority of the time I do it this way, and certainly for the point of this video, I'm going to do it this way. So now I'm going to look at adding on the data from 2019 through to nearly the end of 2020, so almost 2 more years, to see how the strategy continued to perform. If we've over-optimized this strategy and developed it wrong, then the equity curve will just drop straight off and it'll be a money-losing strategy. Hopefully the equity curve will carry on up in a similar fashion to what it has been. So let's have a look at that now. So this chart, let's just show you we're looking at from 1st January 2008 through till 31st of the 12th, 2020. We're not quite there yet. We've actually only got up to the 19th of the 11th, 2020. But let's have a look at the equity curve. And I'm pleased to see, look, that we've carried on making new highs. If I show you this chart, each green dot shows new highs. So we can clearly see that I haven't over-optimized this strategy and it has continued to work, which is great. Let's have a look at the average trade. And the average trade is 9,400. Which is great because that's ever so slightly higher than it was previously at 9,200. 9,400 is still not huge. It's equivalent to 9.4 pips. And obviously we're going to be exposed to paying trading costs in terms of spreads and commissions. So let's have a look, just out of interest. What I can do is add some trading costs into this. So I can put in here, put in 4 pips worth of trading costs. That's quite a lot. We probably wouldn't be paying that, but we put in 4 pips and see how that changes the equity curve. Now we can see that we've only got 5,300, not 9,000 something because of that 4 pips. But let's have a look at the equity curve. And the equity curve still looks okay. Look, we're still making new highs, which is great, and that's in our out of sample data, not the data that we've developed the strategy on. So what I would do, and what I probably will do, is leave this strategy for a good minimum of 3 months, maybe between 3 and 6 months, just to make sure that the forward data that I've never seen, I don't have access to yet, just to make sure that the strategy keeps on performing in the right manner like it did throughout the development, and then I'll consider trading it. After that last video I done, where I used the Multicharts built-in indicators and the built-in signals and completely failed to make the MACD strategy work on those Forex pairs. I'm really glad that I persisted, and a week later I can show you this with something that's quite usable using just a simple idea that I came up with. I don't generally use a lot of indicators in my strategies, as some of you might know. But for those of you who don't use trading software like Multicharts, using indicators is quite an easy, nice visual way to look for trade signals to enter and exit the markets. So maybe you've got some other indicators that you'd like me to look at and try and develop a profitable strategy using them. If you have, let me know in the comments, or you can email me, jared@thetransparenttrader.com. And don't forget to visit the website where there's loads of good stuff just like this. So until the next video, this is Jared Goodwin, and thank you.